every way, banks make money explained. Interest on loans. Buying a house today instead of waiting 20 years sounds like a great deal, but someone has to make that possible. That's where banks step in. When you apply for a mortgage, car loan, or personal loan, the bank gives you the money up front, then you repay it over time with interest. Think of interest as the price of borrowing someone else's money before you've earned it yourself. The process looks simple on the surface, but behind every approved loan is a long list of financial checks. Banks examine your income, credit history, existing debts, and even the value of what you're buying. The goal isn't just to lend money, it's to make sure the loan is likely to be repaid. That's important because one large default can wipe out the profit from many successful loans. Longer loans usually generate more total interest, which is why a 30-year mortgage often costs far more overall than a 15-year one. Even if the monthly payments are lower, lending isn't simply about handing out cash, it's about carefully balancing opportunity against risk. One borrower at a time, credit card interest and fees. Swipe your credit card at a coffee shop, and the payment is approved in seconds. It feels like the transaction is over, but for the bank, the story may just be beginning. If you pay your full balance before the due date, you usually won't owe any interest at all. But if even part of the balance rolls into the next month, interest starts building on what's left. That's one reason credit cards can be so profitable. In the United States alone, consumers carry well over $1 trillion in credit card debt, creating an enormous source of interest income for banks. But interest isn't the only piece of the puzzle. Some cards also generate annual fees, balance transfer fees, cash advance fees, foreign transaction fees, or late payment charges. Of course, not every customer pays these costs. Many people avoid them completely by using their cards responsibly. Instead, banks rely on millions of customers behaving differently. Some pay immediately, some carry balances, and together those different habits create one of the banking industry's biggest revenue engines: bank account fees. Open your banking app for just a moment. You'll probably see features you use without thinking: checking your balance, transferring money, withdrawing cash from an ATM, sending a wire, or replacing a lost debit card all seem routine. Behind each service, however, is technology, security systems, customer support, and infrastructure that cost banks money to operate. That's why some accounts include maintenance fees or service charges. The interesting part is that these fees are usually small enough to feel almost invisible. $5 here, $10 there. Yet when millions of customers pay similar amounts, the total quickly grows into billions of dollars each year. Fortunately, many of these charges are avoidable. Banks often waive monthly fees if you keep a minimum balance, receive direct deposits, or meet other account requirements. In other words, the fee isn't always permanent. It's often designed to encourage certain banking habits. What feels like a minor line on your statement becomes a steady and predictable income stream when repeated across millions of accounts. Investing customer deposits. Here's a question many people never think to ask. If your money is sitting safely in a savings account, how can the bank afford to pay you interest? The answer is that your deposit usually doesn't stay idle. Banks keep enough cash available for everyday withdrawals, but much of the remaining money is used to fund new loans and other approved investments. This system is called fractional reserve banking, and it's one of the reasons modern economies keep moving. Imagine a bike rental shop. If every bike stayed parked all day, the business wouldn't earn much. Instead, bikes are constantly rented out, returned, and rented again. Banks work in a surprisingly similar way with money. Naturally, that raises another question. Is your savings still safe? Under normal conditions, yes, banks are required to meet strict financial regulations, maintain reserves, and in many countries, customer deposits are protected by government-backed insurance up to certain limits. The same dollars sitting quietly in your account may also be helping someone buy a home, start a business, or expand a company somewhere else in the economy. Payment processing fees. Tap your card, your phone, or your smartwatch, and within a couple of seconds, the payment is done. It feels almost effortless, but behind that simple beep, several companies and banks have already exchanged information at incredible speed. First, your bank checks that the account is valid and has enough available funds. Then the merchant's bank receives the approval while the payment network securely connects both sides. All of this usually happens before you can put your wallet back in your pocket. Every transaction also carries a small processing fee, which is typically paid by the business accepting the payment rather than the customer. One purchase might earn only a few cents for the financial institutions involved. That doesn't sound impressive until you realize billions of card payments happen around the world every single day. Those tiny fees stack up into billions of dollars in annual revenue. As more people choose digital payments over cash, banks don't need larger fees to make more money. They simply benefit from more people tapping, swiping, and clicking every day. Investment and wealth management services. Imagine receiving a large inheritance, selling a successful business, or saving millions of dollars over a lifetime. Suddenly, deciding where to keep your money becomes much more complicated than choosing a savings account. That's why banks offer investment and wealth management services. Instead of simply holding your money, they help clients build investment portfolios, prepare for retirement, manage taxes, and plan how wealth will be passed to future generations. Rather than earning interest, banks usually collect advisory or management fees based on the amount of money they oversee. For example, managing a $5 million portfolio can generate recurring income year after year without the bank lending a single dollar. Of course, markets don't always move upward. Investment values rise and fall, and no advisor can guarantee profits. The real value comes from helping clients make informed decisions over decades instead of reacting emotionally during every market swing. For banks, these long-term relationships often become some of their most stable and predictable sources of revenue. Business banking services. Running a business involves much more than selling products or serving customers. Employees need to be paid, suppliers expect invoices on time, card payments must be processed, extra cash has to be managed, and sometimes the business needs financing to grow. Instead of offering just one service, banks often provide all of them under one relationship. A company might have a business checking account, payroll services, merchant payment processing, commercial loans, business credit cards, and cash management tools, all from the same bank. That's exactly why business customers are so valuable. One company can generate income from multiple banking services at the same time. But lending to businesses also carries larger risks because commercial loans are often much bigger than personal loans. Banks carefully analyze financial statements, cash flow, and future business plans before approving major financing. A successful business customer doesn't just borrow money once, it may continue using banking services for decades, creating a long-term partnership that's valuable for both sides. Trading and financial markets. Most people think banks simply hold deposits and make loans. In reality, many of the world's largest banks also operate deep inside global financial markets. Every trading day, they help clients buy and sell stocks, bonds, currencies, and other financial assets worth enormous amounts of money. In fact, the global foreign exchange market alone sees more than $7 trillion traded on an average day. Banks don't own all of those transactions, but they play an important role in helping buyers and sellers connect efficiently. Some trading activity is done on behalf of customers, while certain banks also earn profits from carefully managed market positions within strict regulations. Because prices can change in seconds, this is one of the fastest moving parts of the financial industry. It also happens to be one of the most heavily regulated. Unlike a neighborhood branch that serves local customers, a bank's trading floor operates on a global scale, where information, speed, and risk management can matter just as much as the money itself.